So today we're going to be talking about trading earnings using measured move targets. Now, how many of you out there have tried to trade earnings in the past but realized that maybe you were losing more than you were making on trades when um, you were right, and that it just didn't turn out to be a profitable endeavor in the long run? Or maybe you've never traded earnings because you've been told that it's too risky or that it's not something that smart traders do, right? Yeah, a lot of people are saying, yes, that's exactly what I've heard. This is, someone says it's better to sit at a blackjack table. Right, so a lot of people think that, and I think that that is incredibly misguided way to think about trading earnings and any other kind of catalyst event. So what we're going to do is talk about trading earnings and individual equities here. That's the context of what we're going to be discussing these strategies and these analysis methods in. But keep in mind as we go through this that you can really apply this type of concept and these ideas to any type of catalyst event, not just individual equities that are reporting earnings, right? I can use the same ideas and same concepts to set up trade strategies around unemployment number, around Fed announcements and Fed minutes, around crude number, around crop reports, pretty much anything. All right, and the reason that I can do this and make money in the long run, whereas so many of you are saying you've struggled to trade earnings in the past, is because I use equity options and I use specific reward to risk setups. So let's just jump right into this and get started. So before we do, I do want to read our standard boilerplate risk disclaimer. Day trading, short-term trading, options trading, and futures trading are extremely risky undertakings. They generally are not appropriate for someone with little capital, little or no trading experience, and or a low tolerance for risk. Never execute a trade unless you can't afford to and are prepared to lose your entire investment. All trading operations involve serious risks, and you can lose your entire investment. No trades or recommendations or advice, and we cannot be sued for losses of capital. All trades are for educational purposes only. Please contact your broker or registered investment advisor for execution margin and all other capital requirement questions. Everyone watching this presentation adheres to all disclaimers on optionhacker.com and alphashark.com. All right. So, I'm not going to spend too much time talking about myself because Reed gave me a very good introduction there, but my name is James Ramelli, and like you said, I actively trade a lot of different products, but this time of year, and this happens 4 times a year, when we're in the middle of the earnings cycle and we're in the full swing of it and there's hundreds of stocks that report every day, I'm pretty much trading equity options exclusively, okay? And the reason that now is a really great time to learn this trading plan is because we're right in the middle of earnings season. This is the time of year where we can tend to see markets get a little bit slower, a little bit choppier. We've definitely seen that in the broader market. So when that happens, I have to look for other opportunities and other places to deploy risk capital where I actually have a chance to make a little bit of money. Okay? So earnings, we're right in the middle of the cycle. There is a ton of stocks that are reporting on a daily basis right now, and it gives me a lot of opportunity to trade the options market around those catalyst events. Public companies release their earnings every single quarter. They announce revenues, guidance, and earnings per share, but all of you know this. What most people don't know is that earnings is one of the most important factors in the underlying price of a stock, right? A price of a stock, when I look at Lululemon and see 48.49 as where it closed on Friday, 48.49 really represents the discounted value of all of its future cash flows, all the money that the company is going to make in the future. This is the discounted future value, present value, right? So when there's a small change in earnings, it can have an incredibly large effect in the price of the stock, right? And that really large move in stocks that we see on earnings, it can be really dangerous if you don't know what you're doing and you don't know how to set up good trades around that. But it can also present a lot of opportunity. Now, a lot of you said that, hey, I have tried this in the past, but it seems like when I lose money, I lose way more than I make when I'm right and the trade goes my way. What I'm going to teach you guys how to do is how to completely flip that dynamic, right? So when I do lose money using this plan, I lose a little bit. But when I make money, I make a whole lot more. And that's the name of the game. That's how I stay in the game longer. I can set up earnings strategies, and even if you truly do believe that an earnings play is a coin flip, meaning it's either going to rip higher or rip lower, with me having no idea how to figure out which direction, even if you do believe that, this trading plan is still going to show you how you can make money trading earnings using good risk versus reward setups. Now, I, for one, truly do not believe that that is the case. I believe that by using the analysis method that we're going to go over here, I have a much better chance of picking the correct direction for an earnings play And I'm also going to talk about how we can fade the directional movement as well. There's a lot of different ways to attack an earnings strategy, but for an example, this past quarter, not the current quarter that we're in right now, this past quarter, out of 65 or so trades that I took, I had about 32 winners. It's actually a hair below 50% win rate, right? And that might not sound that interesting, right? They might say, well, that doesn't seem like that good of a number. If you're only winning 50% of the time, how do you make money in the long run? But the way that I structure the trades with a 50% win rate, I can still have an ROI of 30% over just one quarter, okay? So the main reason that, exactly, profit factor is everything, and that's what we're going to talk about here. But the main reason that people have trouble trading earnings, and this is kind of the whole crux of the issue with traders that don't like to trade earnings. They don't think about these things, or they have in the past without considering these things, and that's why they've lost money. But a lot of people don't account for how much a stock can gap on earnings, right? Every stock has an average amount that it moves on earnings day. And we can figure out this average over the past 4 quarters, the past 8 quarters, the past 20 quarters. It doesn't really matter, but what it tells us is how volatile a stock can be on earnings. It's really important to understand before you put on a trade ahead of earnings whether or not the stock that you're looking at moves 5% on average on earnings day, or if it moves 15% on average. It's going to completely change how you approach the setup. Okay, and it also is going to completely change how you're going to structure your reward to risk ratios in the strategies that you're looking at. But another really big reason that people lose money trading earnings and they don't know why is because they don't take into account the fact that implied volatility is going to drop quite a bit after the event. How many times, and I would guarantee that anyone in this room right now that has traded options has had this happen to them. How many of you have bought calls or bought puts in a stock, saw the stock move in the correct direction, but saw your position go down in value? Meaning, let's say you've bought calls in the past, you saw the stock move higher, in what seemed like a move that should make your position increase in value, yet you take a look and you're down money, right? That's probably happened to everybody, and that's implied volatility. Okay, implied volatility shows me the supply and demand curve for options. It also shows me how much the market is expecting an underlying stock to move over a certain period of time. Now, implied volatility gets bid up into earnings because, like I said, it represents the supply and demand curve for options. So going into earnings, if everything is working the way that it should and everybody is following the rules, nobody knows what the earnings are going to be. They don't know whether or not the company is going to miss estimates, whether they're going to beat. Nobody knows. So all of that uncertainty creates a demand for options that is, driven by both hedgers and speculators. Those who are putting on positions in the underlying stock come in and trade options to get hedged ahead of a big catalyst event like earnings, and people like to come in and speculate. Now, what that does is it increases implied volatility, which in turn causes options premiums to move higher, right? Then, once the earnings come out, that uncertainty is gone. We see the report. They've done their conference call. We have all of the numbers. We have the financial statements. There's no more uncertainty. The information is out. All of the concern about what was going to happen is gone, and now premium comes crashing down. Why does that happen? Everyone starts to get out of their positions. So these two things, drop in implied vol and putting on too much premium ahead of earnings, are some of the main reasons that traders struggle to make money in the long run and make money consistently when trading earnings. And then the final and most important for me is the risk versus reward setups. So someone mentioned the idea of profit factor. And profit factor shows me how much I stand to gain if I am putting up X amount in risk, right? So if I'm risking $100 to make $200, my profit factor is a 2, okay? I want to have a high profit factor, and no matter what type of strategy that I'm doing here for earnings, I'm never taking a profit factor that is below 1. And believe it or not, a lot of equity options traders out there structure their entire trading style and strategy around strategies that have profit factors below 1, right? This is typically what you see in premium selling options traders. That's what they tend to do. But I truly don't believe in that. So what we're going to talk about here is a bunch of different considerations on what I need to think about before I put on a trade for earnings. So just a little bit more on implied volatility and historical volatility, because this is a very important part of this trading plan. So they both tell me things on their own, right? Historical volatility will tell me how much a stock has moved in the past and what maybe I could expect to do this time around if it sticks in line with historical averages. And implied volatility tells me what the market is expecting this time around for earnings. Individually, they don't really give me enough information to put on a trade. But when I compare the two to each other, one to the other one, I get more info and I can understand whether or not it's more beneficial for me to be long premium or short premium going into earnings, right? And this is pretty simple. When would I want to be long premium going into earnings? When implied volatility is less than historical volatility, meaning when market makers are implying a smaller move than what the historical average is, because then I know that I have a pretty decent chance of gaining money on implied volatility in addition to a directional move in my favor, right? So to trade earnings successfully, you have to understand the difference between historical and implied volatility. So before I move on, is anyone just completely lost and has no understanding whatsoever of what I'm talking about here, the difference between historical and implied volatility? Because as we get into the trading plan here, you're going to see that's one of the most important considerations that I make ahead of a earnings position, ahead of an earnings trade. But good, it seems like we're all pretty much on the same page here. So right away, I need to understand that I can't trade every single stock for earnings, okay? Not every stock is going to be quote-unquote tradable. I only want to, so being long premium just implies that I am putting on some type of debit spread. Yeah, being long calls or spreads, calls or puts or spreads, exactly. So I don't play earnings in stocks that don't have options, okay? Some people said that. How many of you have ever traded stock for earnings, like put on a stock position ahead of an earnings announcement and then traded it afterwards, right? It's not, I don't want to tell people that that's a bad way or the wrong way to trade, but every single time I am able to set up a better risk versus reward setup using options than I am with stock. So if a stock doesn't have options, I really have zero interest whatsoever in trading it for earnings. I don't care. It doesn't matter. I'm not even going to pay attention to ones that don't. All right. I also want to focus on stocks that have weekly options. And we're going to talk a little bit more about why weekly options lend themselves to a better earnings setup than longer dated options. And a big part of that is that I want to isolate the catalyst event as effectively as possible without taking a longer-term view on the stock. Catalyst movement and underlying trend can be very different, right? I don't want to take a view on a stock's price a month from now. I want to take a view on what it's going to be right after earnings, right after they report the event, and everyone has this big psychological reaction to the numbers. Okay, so my favorite stocks are going to be ones that have weekly options, ones that are very popular, intensely followed, widely held, names that I know are going to have a large move on earnings and that I know could have a large psychological effect based on a good surprise or a big disappointment in that EPS number. How many of you watched Microsoft trade on Friday? How many of you watched that stock trade on Friday? Did anybody have a position on in Microsoft on Friday? Right, it was an insane move to the upside, right? There was exuberance on those Microsoft earnings. Traders came in and bid that stock up like crazy, right? You took you took my trade in Microsoft. Yeah, it was a good one, and we'll go over that one a little bit later here. I have examples from this week. This was a really good week for me trading earnings. The trade that someone's referring to here is I bought Microsoft call spreads using this plan on Thursday into Friday, and they quadrupled in value overnight. We're going to talk about that in a little bit here. So now that I understand what stocks I want to play for earnings, I have to understand what strategies I'm going to have in my toolkit. So to trade this trading plan, you do have to have a basic level of options spread knowledge to do it, right? Because I can't really trade outright options ahead of earnings because of that implied volatility effect that we just talked about a few minutes ago. If I am trading outright options, I'm really, really exposing myself to that volatility crush once the earnings are out and once the uncertainty is gone. When I trade spreads, what am I doing? I'm buying an option, but I'm also selling other options against it. So when implied volatility pulls in after earnings, the effect of that drop in implied vol is somewhat softened by the fact that I am short options against long options. Okay? Good afternoon, Mark. Nice, long time no see. So these are the strategies that I look at for earnings, and they're pretty much ranked here in the order of my most favorite to my least favorite for trading earnings. And call and put verticals are at the top of this list because they're the most versatile. They allow me to trade earnings much more simply than all of these other strategies. They're also the most commission light ones. They only have 2 legs. And they let me hone in on measured move targets very, very easily. So I can trade call and put verticals, get a very similar exposure that I would if I was just buying outright options, but I get protection against that implied volatility crush by being short one option against the ones that I'm long. Right? So it's a fantastic way for me to take a view on a stock ahead of earnings, risking less money than I would have to with outright options, right? Because remember, I'm taking in a credit for the ones I'm selling against options I'm buying. And it sets me up with a fantastic risk versus reward setup. You guys wouldn't believe how easy it is to get 3-to-1, 4-to-1 on your money using call and put verticals ahead of earnings. So what does that mean? That means that when I am right and it moves all the way in my favor, I quadruple my money. When I'm wrong and it moves against me, I lose 1 unit, right? So how many, what percentage of the time do I have to be right to make money in the long run, right? And that's the whole point of this profit factor idea that we were talking about a little bit earlier. Can I show an example for next week's stocks earnings announcements like Apple or Starbucks? Yeah, absolutely. I'll go through Starbucks at the end. What we're going to do is we're going to go through 2 examples once we jump into the actual trading plan here. One is one from last quarter that I did in Lululemon. One is from earlier this week that I did. And then we're going to go through one for next week. That's kind of looking at this. Your biggest problem is determining the direction of the move after earnings. Okay, and we're going to talk about that too. And really for this plan, that, William, is just a consideration that you need to make for risk management, right? What we're looking at here are spreads that will pop in value very quickly and give you opportunity to get out if you're correct on the movement initially, okay? So all of these strategies here offer a trader a better risk versus reward setup and a more defined risk versus reward setup than outright calls or puts. And the reason that I always prefer verticals to outright calls, people ask me this all the time, hey, if you think that a stock is going to go up on earnings, why wouldn't you just buy calls? Well, I have a way to calculate exactly where I think that stock is going to go on earnings. So there's no reason for me to come in and buy calls, risk more money for unlimited upside when I know when I know there's a ceiling in the stock. When I calculate that, there's no reason for me to try and make money if it moves past that. I want to participate up until that level and then stop. And that lets me risk even less money and get a better risk, more well-defined risk versus rewards setup. No, I never do straddles or strangles. I think straddles and strangles are a terrible, terrible earnings trade. And I really think that it is one of the worst ways to put risk capital in play ahead of earnings. And there's several reasons for that, and I'm glad you asked that question. Someone always does. We just talked about the implied volatility crush that happens after earnings, and I don't want to be long outright calls or puts ahead of earnings because implied vol is going to come in after earnings. So why would I want to be long calls and puts at the same time going into earnings? A straddle is the purest volatility play that you can take, the purest long volatility play that you can take. So I don't want to get long all of that volatility right ahead of earnings, because what I'm doing by buying that straddle is basically saying to the market, hey, market, you are wrong about how much you think this stock is going to move on earnings, and I think it's going to move more. I just said that I can get 3-to-1, 4-to-1 really easily on calls and put spreads. So how much do I need a stock to move to quadruple my money in a long straddle? Well, I need the stock to move 4 times what the market maker was expecting it to, and that rarely happens. Selling straddles and strangles, I think, is a terrible trade as well, because it exposes me to an unlimited amount of risk, right? Most times it would work out, and I'd be short implied volatility, and I'd see a nice little bump in my position the next day when we come in and we see implied vol dropping. But what happens when I have a situation like Microsoft, where the stock did move way more than what they were expecting? Well, I'm getting smoked in that position now, right? What if they make an announcement that they're going to do a massive buyback? I mean, there's so many ways that I can lose a ton of money in straddles, short straddles and strangles, that the times I do make money can be erased like that one time I'm wrong. Okay, so it's just not a good risk versus reward setup for me. So before we jump into the actual plan here, and we have just one more slide before we do, be mindful of commissions. We're going to talk about a lot of different spreads here, and the spreads have more commission than an outright position, obviously, right? So if I'm trading a butterfly, a condor, an iron butterfly, those are all four-legged trades. Iron condors, they have 4 times as much commission involved as a outright call or put. So it's really important to pay attention to how much your commissions are taking away from your total edge in the position. Let's say that if I buy a $1 wide butterfly, how much is that butterfly worth at max value? Well, it's worth $1 at max value. If I'm doing that in a position and my commissions are $1.50 per contract, well then I'm losing 6 cents on my entry price and on my exit price with that butterfly. That's 12 cents, 12% of the entire possible value of the spread. That's a lot to give up, right? So you have to pay attention to that and then make a decision on whether or not the stock that you're looking at is going to be friendly for that type of trade. So that tells you right away, the more complicated spreads, what type of stocks are those going to trade better in? More complicated spreads trade better in more expensive stocks because you can do wider spreads and your commissions start to represent a much smaller piece of the overall value of the spread. Okay, so with that, let's jump right into the trading plan here. And this is the analysis method that I use for every single earning setup that I take. And I go over this every single day on every stock that I want to trade earnings for. And I know that there's a couple of people in here that have seen me do this live in real time in our trading room, go over all of these earning setups, but this is exactly how I do it every time, and I do it every time the same way every time because I want to have a methodical and systematic approach to breaking down these setups. I don't want to take different things into consideration for every setup. I want to have the best way to analyze and determine if it is a high probability setup. So we have these 9 steps, and we call it the HIM-CRIBIT trading plan. It's an acronym. I know it's not the most eloquent thing around there. If you guys have any better ideas for what we can call this, please let me know. But the acronym stands for historical movement, implied volatility, measured move targets, chart, risk, reward, break-even time, and target. All of these things are things I consider in a setup before I take a trade. And what's great about having a 9-point analysis method is that I can really be very, very conservative and very selective if I want to, or I can open up my range a little bit depending on how aggressive I want to be. So what does that mean? That means that if I really want to be super conservative, I can only take trades where every one of these 9 points looks perfect. If I want to get a little bit more aggressive, then I can consider doing something a little bit differently and saying, okay, well, the chart isn't quite as good. Maybe I can still take the setup because the rest looks okay. But let's jump right into the setup here. So this is from the last time that Lululemon reported earnings, and this is the exact trade that I did in Lululemon. So Lululemon was trading right around 63.60 going into their last earnings report. Obviously, the stock is much lower than that now. They did not have a good earnings release when they most recently reported, and they have not had a good, easy time of it since then. But the first thing that I need to analyze is the historical movement patterns in Lululemon. So I can see that over the past 11 quarters, Lululemon had sold off 7 times and rallied 4 times with an average move on earnings day of 10.56%. So what does that tell me? It tells me right away that for whatever reason, Lululemon tends to sell off on earnings rather than rally. Sellers tend to come in rather than buyers. Whether that means they have historically poor earnings, a declining earnings cycle, or whether or not that means they have a general expectation that's a little bit too high that they tend to miss, it doesn't really matter to me. All I need to care about is the pattern in which it trades on earnings. Where do you get that historical movement info concisely? So we offer something called Earnings Hacker that spits this out in a format that looks just like this, but there's also a website called Option Slam that has historical earnings data for free, and you can use whichever one you prefer. Obviously, I think ours is better, but Option Slam has all this data as well. Implied movement is calculated very easily. All I do to calculate an implied movement is look at the price of the at-the-money straddle, right? So all I do is look to see where the at-the-money straddle is trading to then figure out what the market makers are expecting Lululemon to do on earnings. Okay, so someone asked about Starbucks a second ago. Let's take a look at Starbucks really quick, and I'm going to show you exactly how the implied move gets calculated. So here we have an options chain in Starbucks. They have earnings next week. The stock's around 62.61. So I go to the at-the-money straddle, which will be the 62 half straddles, and I see where that is trading, and it's trading at $2.88. So what that tells me, and this is so much simpler than sitting down and using the implied vol equation to figure out what they're implying, what this is telling me is that market makers are expecting Starbucks to move $2.88 either higher or lower by expiration next week. So when they have earnings, this is what the expected movement is in Starbucks. So that's all I did to calculate this expected movement ahead of Lululemon earnings and get my implied move. So what do I see right away here? I see that the implied move is 10.4%. It's pretty simple. All I do is divide this number by where the stock is trading, and I get what the implied move is. So if the implied move is 10.4%, and my historical average move is 10.56%, what does that tell me? Are options overpriced, underpriced, or fairly priced going into this catalyst event? Well, it tells me that the options are fairly priced, right? That they're saying that the stock can move 10.4%. On average, it moves about 10.5%. Market makers are saying to me, hey, you know what? We're expecting Lululemon to move pretty much in line with historical movement. So then I know right away that I can be long options and I don't have to worry too much about the stock not moving enough in the right direction. I know that they're expecting it to, so it most likely will. Now I can use that to calculate measured move targets. So with the stock trading at 63.60, all I need to do is add this straddle price to the stock price to get my upside target and subtract it from the stock price to get a downside target. So then I know where the kind of ceiling and floor is for the market maker's expectations for the stock through the end of that expiration, right? And I was using weekly options in this just like I would in anything else. So with these levels in mind, I then need to look at the chart. The chart analysis is going to be something that I could do very quickly. I'm not a huge technical. I like to, do a super in-depth breakdown of a chart because it's just not my style. It's not something that I really like to pay too much attention to. But I do really much enjoy using the Ichimoku Cloud to do a very fast analysis when I'm trading earnings. During the swing of the cycle, there might be 110 stocks that report in one day. So I have to be able to go through these very quickly. I can't spend 20 minutes looking at each chart trying to figure out what it's telling me. So what I use is the Ichimoku Cloud. Who here has never ever heard of the Ichimoku Cloud before? Who has never seen it, never used it, has no idea what it is? Anybody? I'm sure there's probably a few people. There's a lot of you here. Yeah, a lot of you are saying you've never seen it. So it's a very intimidating looking study, meaning there's a lot going on, but it's really easy to read. It helps me identify overall trend, confirm that trend, spot support and resistance, and rule out weaker setups in earnings just at one glance. All right, so take a look at this trade here. This is the chart of Lululemon, and like I said, it's an intimidating looking study, right? But it's really easy to read, and for this plan, all you need to do is look at the shaded area that's here, this orange area. This is the cloud, the quote-unquote cloud. And what it tells me is that anything trading above that area is in bullish territory. Anything below it is in bearish territory. And anything inside of the cloud is in neutral territory. So what do we see here on the day that Lululemon was going to report earnings? We see that the stock is technically above the cloud, but during that session, here's the low of the day, during that session it had been chopping up and down from the bottom of the cloud to the top of the cloud, back to the bottom, back to the top. So it told me that traders were indecisive about Lululemon going into earnings, and obviously that is a big red candle the day ahead of earnings. So sellers were coming in. With a chart like this that's very sideways, with a very sideways looking cloud, meaning the cloud itself is not sloping higher or sloping lower going into the event, we call this a neutral setup, right? A neutral to bearish setup, because the stock had tested below the cloud that same day and it was a very sideways cloud. So then I need to figure out how I want to actually play this. And it's very, very simple to understand how to set up a put spread or a call spread on earnings. I always want to be short the strike where I think the stock can go. Okay? I want to be short the strike where I think the stock can go. So if I have a downside measured move target of $57, I want to be short the 57 strike. So here I was able to buy the 59, 57 put spreads for 44 cents. It's a $2 wide put spread that expired that week, where I risked $44 per one lot to make $156 per one lot with a break even of 58.56. Now let's talk about why this trade sets up so well for Lululemon earnings. Well, they're telling me, the market is telling me that the stock could trade as low as $57 on the event. Okay, so here I have a strategy where I start to make money a full $1.56 above the level that they say the stock can go to. So if it sells off and doesn't move that full target, I still can be profitable in the end. And it also gets me right on that downside target. And why is this the strategy that I want to pick? Why was it this particular strike structure? Well, this gives me the best looking reward to risk ratio with still letting me participate, while still letting me participate all the way down to that downside measured move target. And risking 44 cents to make $1.56 gets me better than 3-to-1 odds on my money, right? How hard is it to get that type of setup or that type of return when trading stock? It's incredibly, incredibly difficult to do that. But I was able to set that up fairly quickly and fairly easily just by looking at all of those data points. My historical movement, my implied movement, all of this was indicating that Lululemon was more likely to sell off than rally on earnings. And what happened? The stock got absolutely slammed on earnings. Absolutely crushed. So then this brings me to the next part of the trading plan. And the last two steps of the plan, because we just went over, risk, reward, and break even in that last slide. But the last part of the trading plan is all about what happens after the earnings come out, right? So what do I do here in Lululemon? Well, the earnings have come out. The stock has gotten absolutely destroyed, and I was short via these put spreads. So what happens? What do I do? I have to keep my time and target in mind. So I know that these options expired on September 11th, which was a Friday. Okay, the stock gapped lower that morning, and I was able to sell these for as high as $192 that day, and they closed for $2 on expiration. So they went from 44 cents to $2 in just a couple of days because I had such a good risk versus reward setup. So what is $2 into 44 cents? Well, that means, my position increased in value by a factor of 4.5, right? That is a big, big move higher. So someone answer me this. Let's say I take this trade 5 times, right? How many times out of that 5 times do I need the trade to make money for me to be profitable in the long run? Let's say I take the trade 4 times. How many times do I need the trade to be profitable or to work out like this to be profitable in the long run if I do it 4 times? Well, only once, right? Only one time. So if you don't think that earnings allows for an analysis that can get you within the ballpark of even a 50-50 chance of getting the direction right, it doesn't matter if you're setting up spreads like this. Now, I truly believe that looking at historical movement, looking at the directions in which it's moved in the past, and then looking at how we're setting up on a chart this time, and then only taking strategies and trades ahead of earnings in stocks where those things agree with each other, meaning we have a bearish chart and bearish historical movement, or bullish chart and bullish historical movement, I think I have a much better chance than 50-50 of being right directionally. And even if I don't, the fact that I'm getting such good potential return on my money means that I don't even need to be right that often to make money in the long run. All right? So after I am correct and the stock moves in my direction, do you take the other side too? That's actually a really good question. I'm glad you asked that. So a lot of people say to me, okay, well, if this is such a good risk versus reward setup and you can make money by being directional, why don't you play both sides? Why don't you buy the call spread and the put spread, and then one of them is likely to work out, right? Well, yeah, that is true, but what do I do by then taking the other side? Well, I've cut my risk versus reward in half. Right, I've cut my potential reward in half because now I'm putting in twice as much capital to try and take a view on this stock ahead of earnings. that's not going to be profitable in the long run. It's going to be really difficult to make money in the long run. I want as big of a profit factor as possible, because then what happens when the stock reports earnings that are exactly in line with expectations and no one cares and the stock is unchanged on earnings? That can happen too. Well, then I lose two ways, right? So in my mind, and this is how I've always traded, it's much, much better to pick a direction and give myself the opportunity to have that big risk versus reward winner like that, okay? So, like I said, the stock gap lower that morning, and I have ways that I like to manage these spreads, okay? I like ways that I like to manage these. I will sell half of the spread at a double when I can. That way I have the other half on with house money, or quote-unquote house money. I don't really like that term, but I can't take a drawdown against my initial invested capital if I sell half for a double. Okay, and then I will hold the rest to expiration. In this case with Lululemon, the stock sold off so hard, I was able to get pretty much max value right on the open that morning, which is a fantastic setup. Okay, so any questions about this so far, guys? We don't have a whole bunch of time left, but I do have enough time to, I'm going to run through a couple more setups here. What is my historical earnings results based on this strategy? So I don't keep super detailed results on just this strategy because I trade a lot of other ones as well. But like I said, in our trading room, we go over these every single day, and someone in our room actually kept meticulous track of the results and how they were able to apply this plan to their own trading plan and shared that with me. I don't have the spreadsheet to share with you guys because it does belong to one of our customers. But what he had found was that doing this plan, he was able to make money about 50% of the time, but even though he was only winning half the time, had an ROI of better than 30%. So that's a fantastic, fantastic return. We call it a war of attrition, right? I call it a war of attrition. That's what earnings trading is. I take a lot of trades. A lot of them lose. I'm going to be completely honest. A lot of them do lose. Earnings is tough. I never know for sure which way it's going to go, but the ones that win make so much that it more than makes up for the ones that lose. Okay? So someone says, guess because of market makers you never can close for max value, but rather than max value. Yeah, so that is a good point. You can't ever sell a spread for max value ahead of expiration. It's not going to happen. You might be able to leg out of it for max value, but that's dangerous in and of itself. Market makers have zero reason to pay you max value for something, right? Because why would they pay you $2 for something that can only be worth $2? It's a no-gain situation for them. So what does happen on expiration, though, is, you know, I had the 59, 57 put spreads here in Lululemon. What happens on expiration is if we're below 57 bucks, the 59 puts I have become long stock at 59. The 57 puts I have become become short stock at 59. The 57 puts I have become long stock at 57. And then what does that net out to? $2. So I can get the max value by holding through expiration. Okay, so let's go through another example here, and this is exactly how I do this every day. I write this out every day for every stock I'm going to trade for earnings. This is a little bit more condensed than what we just went over, but this is exactly what I look at. So and there's a bit of a typo there because I copied it right from my journal. But here we have the example in AXP. And AXP reported earnings this week. And I knew that I wanted to trade AXP. I know that it moves well on earnings, and I've traded it in the past with quite a bit of success. So I saw that the stock had sold off 8 of the past 12 quarters from earnings to expiry with an average move of 3.26%, right? So right away, what do I notice there? That's a pretty darn bearish pattern. My implied move with stock trading at 76.75 was about $2.30. You took this AXP trade as well? Yeah, we had an open house this week. It's funny, a lot of people in here are like, "Oh yeah, I took that trade. I was in that trade." But my implied move was $2.30 with stock trading at 76.75. So divide 230 into 76.75, and it tells me that market makers this time around are implying about 3% in movement in AXP on earnings. So what does that tell me about the price of options? Pretty fair, right? I know that they're not overpricing options going into this earnings. Then I calculate my measured move targets. My downside target was 74 45, and my upside target was 79.05. So with those levels in mind, I was then able to take a look at the AXP chart going into earnings on the daily bar, and what did we see? This was the daily bar that we had in AXP that put this trade on. What did I see? And you can't really see with this black pen. Let me change the color. What do I see? Right here. I can see that AXP, very similar chart setup to Lululemon. The cloud is sideways throughout this range, but we are inside the cloud on a big red candle, right? Inside the cloud on a big red candle. So I know that this is not a bullish chart setup. It's not a bullish chart setup by any means. No one would look at that chart and say, wow, the AXP looks awesome here. I think I want to get long based on the chart. The stock was just above the cloud, very sideways, and had been testing into the cloud and closed inside the cloud that day. Neutral to, oh, that should say neutral to bearish. That's another typo. Like I said, I took these right out of my journal, which I don't always have the most diligence in making sure everything is grammatically correct and spelled right. But I ended up buying the AXP weekly 75 half, 74 half put spreads for earnings for 27 cents. Now, this trade set up just like that Lululemon trade, right? It set me up with my short strike right on that downside target, and lo and behold, what happened in AXP? Well, the stock sold off, traded as low as 71.39 that day, and even if I would have held it through till Friday, I would have been all right. But that day that this came out, the day that we came in and AXP was getting absolutely destroyed that morning, I was able to sell the spread for 97 cents, right? Another huge winner using this trading plan and helping it guide me into a short setup here in AXP. Yes, I always put the spreads on one day before earnings. All right, so let's go ahead and jump into what I have to offer you guys today, because I want to be able to answer more questions. And I want to offer you guys a chance to come check out our earnings trading plan workshop that we are going to be offering to you guys today on demand for a massive discount. We only have 25 spots that we're offering today, but what we're going to talk about in this workshop is our step-by-step earnings and analysis trading plan, much more in-depth than what we just went over. There's a lot more minutia that we did not get to cover with this plan. We're going to talk about the best option strategies to trade ahead of earnings and how to know exactly when a call or put spread works better than a butterfly versus an iron condor versus an iron butterfly versus a condor, right? We're going to teach you guys exactly what to look for to make that determination. We're going to talk about how to avoid buying too much premium and implied volatility ahead of earnings, and how to actually figure out when it might be beneficial to sell that in premium and implied volatility ahead of earnings. And then we're going to teach you how to set up the trades to do that. We're going to talk about the best tools for trading earnings setups and how to set up the targets for spreads using market maker targets for any type of spread. We're going to talk about that for any type of strategy that I might want to do on earnings. And I'm going to talk about how to scan for the best earnings plays in the Thinkorswim platform. We're going to offer this to you guys today for $99, which is 80% off our regular website price. This workshop is a recording, so as soon as you make your purchase, you are sent a link to a web page that has the recording, and you have that recording for life. So you have access to it on an unlimited level for forever, right? You're never going to lose access. So to answer your question, Rosa, you can go back, reference it as many times as you want. You're going to have access to it forever, okay? And it also comes with a version of this presentation that you just saw now. So if you don't necessarily have the time to go through it now and you want to come back to it a little bit later, you can watch the prep session again and then jump right into the workshop. It's about 2.5 hours long, all right? And just like with all of our other workshops, we have a money-back guarantee. So if you have any issue, you don't believe that you got $99 worth of value out of this workshop, first of all, I would be very, very surprised. And second of all, I don't want the $99 from you then. We don't want to have unhappy customers. So please check it out. I really think that you guys are going to enjoy it. If you have any desire to learn how to trade earnings or learn more about trading options on earnings, this is a fantastic workshop. This strategy is my bread and butter, right? This is how whenever I go on CNBC, Bloomberg, Fox Business, BNN, this is what they want me to talk about. They want me to break down how options are signaling ahead of earnings, right? I'll be on TV next week to do it for Apple most likely. Do you have to be a member to get lifetime access? No, 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 not at all. As soon as you make this, purchase, you fill out this link, you are sent a recording, and you have access to it forever. And like I said, we have a money-back guarantee for this, just like with all of our workshops. So if you don't like it, you can get your money back. Basically, what I'm offering you is a chance to take a trade where if it doesn't work out for you, you can get your money back, right? I would take that every single time, no matter what. What is my win ratio on earnings trades? So that's kind of the whole point of everything we were just talking about. The win ratio is not as important as net P&L, right? I don't really care about the win ratio that much, because I just told you guys that, you know, if I have a spread that I quadruple in value when I'm right, and when I'm wrong, it goes to 0. Well, you know, the win ratio isn't really going to tell me that much. Someone says the key is to actually take many to get. Yeah, exactly. Like I said, it's a war of attrition, right? And we were talking about this a lot this week, because this was a week where I think right around half of the trades that I took made money, right? And that was more than enough to make it a fantastic week, right? I was looking at butterflies in Google that went from $3 to $19 on the close, right, on Friday for earnings. Amazon had a big move higher. Microsoft quadrupled in value. AXP quadrupled in value, right? IBM had a big move to the downside and saw really nice profits. Right, yeah, I was unable to get a fill in Google. Everyone else did, though. Everyone else was able to get into that Google trade. So any other questions, guys? I think we only have a minute or two left here. Do you get the analysis? So in the workshop, I go through front and back how to set up these trades. This is a very recent recording. We just gave this workshop this past week, so it has really new information. It's actually more up to date. It's actually more up to date than the one that you would purchase from our website. So yeah, it's really good. I think you guys would really enjoy it. I think that it's so comprehensive. I mean, you can go through this workshop, then immediately next week start trading earnings using this plan and doing this analysis like that very easily.